guys, we're just signed on. This is Grassi Franchise Services. We're going to be starting in just a couple of minutes if you guys can hang tight. Thanks so much.
Excellent. Is Brian going to start the agenda introducing us, or are we just going to jump in?
Nope, you can just jump in and thank Brian.
Yep. Good afternoon, everyone. This is James Bowl. With me, I have Gregory Hedger from Grassi Franchise Services. I appreciate everyone joining the call to kind of go through some information about our firm, as well as some information in regards to the new tax law. Also, wanted to see if we can thank.
Yeah, we wanted to thank Brian. He had helped us, reached out to our firm, and we had some preliminary conversations with him, and he helped us facilitate getting on this webinar with you today. So thank you, Brian. We know that you're in attendance, so thanks for joining, and here we go.
Excellent. So we like to make this interactive. If there's any questions, by all means, in your queue, type in the questions. We'll answer them as we see them. We do not need to wait for the end of the presentation. We do have an hour earmarked. The information that's being presented, we used to do for CPE that can go over 3 hours. So we'll go very broad, and we can definitely fine-tune some of the answers with some of your questions. With that, I want to have Gregory take over and discuss some of our services, and we'll go from there.
Perfect. So we are a full-service CPA firm, and here are the left and right columns. These are some of the services or what you can expect as a client of Grassi Franchise Services. You will receive monthly financial statements. Oh, sorry about that. Okay. Yeah, I think it's timed. So sorry about that. Technical difficulties. We'll get them figured out. So I'll talk as we go through it. The monthly financial statements that you can expect to receive will have benchmarking, and that benchmarking that we're going to go through in great detail in a few slides is what's going to make us different than any firm out there that is currently providing services to Massage Envy as well as franchises. We are going to prepare strategic advice for all of our clients. So what would be encumbered of that? We are going to look at whether you need to be an S Corp, should you be a partnership, do you have basis computations? So these are conversations that we're having with our clients on a regular basis to make sure that they're prepared for the year end and when, as well as tax law, which we included in this presentation, but we're going to focus primarily on our services for today. But that strategic advice and tax projections and basis computations is something that we are going to be doing regularly for our clients. Financial reporting to your franchisor, we are going to be uploading to Profit Keeper. So as soon as you receive your monthly financials, those will automatically get uploaded into Profit Keeper in the corporate format. So then you can compare yourself to your peers across the network. Income tax planning, that has to do with making sure that you're in the right vehicle for tax purposes, whether it be a corporation or an LLC treated as such. Sales tax, we're going to be preparing those on a regular basis based on how you should be filing with your state and localities. Personal property tax, depending on your states, which there are many states in the heartland that do require personal property tax filing, so we would take care of those for you. And I did mention the tax projection and basis computation, which are different for corporations and partnerships. Client expectations. James, you want to talk a little bit about that?
Yeah. So this is an important one for us. Basically, all the services we are doing currently started as a basic format, and then through our client experience has changed and morphed. So we're here basically to work for you, not to provide a product that we think is suited for yourself, but a product that you're looking for. So we're looking to eliminate some inconveniences. We do spend a lot of money on robots. It is important to know that technology is here. We have a lot of automation. With that, automation does provide efficiencies, but ultimately, in the end, you do need to have intelligent people speaking with you in regards to explaining what the numbers mean, how these numbers apply to you, and of course, where can we dig in deeper to find improvements to increase your efficiencies as well as your bottom line.
With our experience throughout the years, we've dealt with all of our clients and figured out what they're doing properly and who's executing best among our clients, and then sharing those best practices with our clients. So that the consulting that we're doing with that is ever changing. We're always looking for additional feedback from our clients, looking at the front desk, and as we get into that benchmark chart that I'll show you in a few slides, those are going to be conversations that we're having regularly with our clients so that we're always in the forefront with the changes in the franchise.
Right. And that's one of the keys here is it's an interactive event. We can't do this on our own. We can send information, but without having participation from the owners, them calling, them questioning, we encourage it. It is an all-inclusive fee. We don't charge by the hour. So for us, it's excessively important that in order for us to be successful with you, you have to be engaged with us, at least on a monthly or regularly basis, as we go forward. So as you can see from here, we do have the ability to suck all your data in from your source documents. We download all the monthly statements, all your monthly reports. Everything is directly entered into our accounting software. All this is getting reviewed internally. There are accruals for, we do accruals for payroll. We'll look at your insurances. We'll try to bring your large expenditures that skew your bottom line and break them out evenly throughout the life of the term of the policy and or the term of the year. And the most important thing here is the two-tier review system.
So the two-tier review system is what helps catch the granular detail as well as the large scale. So we have accountants that are looking on a monthly basis at your general ledger, which is the detail of all your transactions, and making sure that they're consistent. We have notes by each client with how certain charges should be classified. So we know that some of our clients, Sam's Club belongs in meals. Sometimes Sam's Club belongs in operating supplies. Those are details that we're going to have with an accountant who's going to specify in the individual transactions. MyRDC is one of the hot buttons right now with making sure that we have the proper allocation between what is used for service as well as what's used for retail. And it's becoming ever changing with Massage Envy throughout the years. Now that everything's ordered through one location, it's more important to figure out there's more retail items. So we just need to be tracking it more. So some clients provide us individual detail of every single transaction from MyRDC, and some we just get the order summaries on a monthly basis. And some clients don't actually want it broken out. So we curtail our services to the needs of our clients, and that's really what we're getting with at this. And going back to the two-tier review system, the second tier is going to look at your financials from a global perspective. They're going to look at the last 6 months and say, okay, does it make sense that we haven't paid rent in a certain month? Does it make sense that we don't have workers' comp paid? And those questions will then be asked to the client, and making sure that we're always on top of your business and making sure that expenses are being paid, for one, and two, just making sure that when you get financials, although the expense may not be coming out of the bank account, should there be an expense there? And that's something that we're looking to communicate regularly on.
Right. And for us, that's the fun part, because that's where the errors are discovered. This is where the inequities are, shown. And, for us to do a good job, those conversations definitely need to be taking place regularly. Additional services that are available, and this is really the key separator for a CPA firm versus a bookkeeping company. These are additional services, but a lot of our clients leave money on the table, or not so much our clients, but clients we pick up after they start someplace else. The end game is eventually you will sell. What happens when you do sell? How is that sales process? We do facilitate a lot of those parts of it. The business valuation, we have internal folks here that do that. But what we find is when we take on a new engagement, most of the people buying your business will be going back 1, 2, 3, sometimes since inception. And if your data is not accurate, if it's not clean, trying to push forth a business valuation and tell them we're pulling these numbers out of your P&L to improve my bottom line, and for EBITDA that we're going to sell to you for a 4 or 5 multiple, these expenses should have never been in there, starts a negative kind of conversation, a negative trend. Those things should never have been there in the first place. So when you get down to selling this, sometimes you'll meet, or most of the time you'll meet in the middle. And that's where you start losing a lot of money on the table, just due from the books and records not being updated on a timely or proper fashion.
There are many expenses that are run through the P&L that are one-time expenses that when you go to sell and you're looking for a multiple of your cash flow, it's important to back those out. Those are conversations that we're having with our clients before we're sending any financials to any prospective buyer. It's important because as soon as you start redrafting financials, you lose the validity and you lose the trust in the data. And if the data is not accurate, it's very difficult to sell based on an EBITDA of inaccurate data. So those are very important conversations to have, and that's a large reason why we want to house all the information and be in charge of that information for you. We don't want you printing financials and sending them to banks, to prospective buyers, because we want to review it first. We want to get the right level individual to review it before anything is sent out, to make sure that those items are taken into account before they're sent.
So the other items that are additional services, but obviously we do recognize and we do respect that other people may have trusted advisors for estate planning or wealth management, but ultimately a lot of the questions we get are start with the businesses and they morph into, hey, I got a quick question in regards to selling. by the way, I was thinking about selling, is there any estate planning? I don't want the government to take my money. There's a lot of rules and regulations that are out there. Everyone that's here is an accountant that's been skilled in the arts of understanding all these pieces. So although we may not be facilitating this for you, it's always easier to ask someone on the phone one quick question. Those quick questions require intelligent people to respond. Trust is in the States. You do sell your monies. Those monies have to go someplace. If your personal wealth is over a certain amount, 10 million plus per individual, anything in excess of the federal exemptions, you start paying 50% tax on. So there is a good amount of wealth in your businesses. So when you do sell, planning properly, gifting prior to selling to children. So those are all great things that we'd love to discuss. And often we do get, talk on a monthly basis about wealth management, the same thing. You have all this money potentially coming in. What do we do with it? We have wealth managers we work with. The ones we work with develop an individual cash flow. We work hard looking at the business, but what about your personal life? How much money do you need to retire? If you do want to retire to X, and these are the goals you have, children getting married, major events, what is the return? I love when people ask me, hey, what's your risk tolerance? You're low, high, or middle? I have no idea. And the bottom line is you're not supposed to know. What you're supposed to know is this is what I have as far as funds. These are the funds I will have when they're coming down the road. This is when I retire. These are my expenses. And to facilitate that lifestyle, what percent in growth do I need? And that's the percent that you want to invest on. So you can ensure that your livelihood when you retire is fully functional and have the funds available.
These are conversations you want to have before picking your sale price as well. Where do you need to get the business in terms of operationally to be able to retire from those funds? Or does it have to be rolled into something else? Do you need to work at other opportunities in order to retire at any given year? So these are conversations that we're almost requiring our financial advisors have with our clients before they proceed with these transactions or planning towards those types of transactions, because they're great conversations to know where you need to be in a certain amount of years.
And that's a great point too. When you do evaluations and you're selling and looking to exit a franchise or looking to get into a franchise, it all starts with the current data, but ultimately in the end, you also want to plan on what you're going to do after life, after this franchise. So we don't look at you as just a business. We look at you as a person. We look at your life, not just today, but going forward. So there's a lot involved into these conversations. I just don't have around the business data, but that's usually the starting point. So the IRS state audits notices, this is a great topic. We deal with the IRS on a daily basis. We have full-time people always calling the IRS because the IRS now has automation as well. They got into technology, so they send out automated notices, and they need to be responded to. So every time we get on a call with the IRS, we always particularly enjoy waiting 45 minutes and hearing that same music over and over again. We know it's only going to get worse from here. The IRS sent out some big notes as far as additional time requirements. They tried to raise their budget. They failed. They actually got less in their budget, so they have less auditors. That means more hold times. But these are the hours the IRS is projecting from this 20% pass-through deduction. It's insane the amount of time that they're looking to see how much this is going to cause everyone here internally as well as externally. So they're projecting 25 million hours in annual reporting requirements for 10 million for corporations and partnerships. The average increased reporting burden works out to 2.5 hours per taxpayer. It's going to be anywhere from 30 to 20 hours depending on each individual circumstance and the number of businesses they have. So the amount of time, energy, and effort going into preparing your personal return, as well as energies looking at your projections, is increasing exponentially due to these tax law changes. The thresholds, if you're under, if you're over, how many times you have to do the computations, if you're right on the cusp of it. These are all the things that take a lot of time and attendance. You definitely want to have a savvy individual that understands these and can explain these information to you so we can make better decisions. A lot of these decisions require year-end planning for depreciation. Should we take it? Should we not? Lose the credit, take the credit, how you receive your payments. These are some of the things we'll discuss in the presentation.
Monthly financial statements. Reporting. There's a lot of automation that goes into the presentation of the monthly financials, and the reason that we've done that is to, one, expedite the preparation as well as maintain that accuracy. The point of sale report, the reason why we use point of sale is the buzzword of millennium to MEVO, which based on the last presentation corporate gave, is not happening until next year with no expected date. So currently we're using Millennium, and we're reporting those revenue reports. We use the MR080 on a monthly basis into your books. Those royalty reports, we also have automated entering into your monthly books on a weekly basis. So those are automatically entered for us. We don't have individuals entering them. They're entered, and then we reconcile and make sure that that gets into the reconciliation part. The bank accounts, credit cards, royalties, NMR80 match what is actually happening in your bank, on your credit cards, with your payroll report. And this is the grassroots of what's happening or needs to happen, so that we can have educated conversations with our clients and advise what changes they need to make in order to effectively run their locations. And this is not based on our own personal experience. It is the experience of our clients and those who are successful, which is all you operators out there.
And ironically, the payroll reports, we had robots entering everything for payroll. Payroll is a unique animal. It encumbers one of your largest expenses. And for us to have a robot entering it was really doing everyone an injustice. There's always one individual that needs to be allocated some crazy proportionate way between all the businesses. You guys have multiple businesses, maybe paid up a management company, how you split, allocate, and across the board. It changes dramatically day to day, week to week, month to month. So that is something we put a lot of time, energy, and effort. It is one of your largest expenses that you can control. And that's the key thing to know is, we want to make sure that is as accurate as possible, because that is really where the money is. And that is a make or break between a profitable business or a non-profitable business.
Monthly benchmarking. What I'd like to do now is I'm going to go through a typical review that we would do with one of our franchise clients and advise where they're doing well in, where they're not, what would be areas of concern, what are the questions we're going to ask in each of these areas. So this benchmark email will be an email that you will receive on a monthly basis. It summarizes 80% of your expenses.
Before you get into that, this whole spreadsheet actually was derived from client participation. And I know every time you get an email from your accountant, you guys quickly rush to your computer, you open it up, you check out every little piece of paper that's in it, you scour it because it's such great information. Not likely. So our clients used to come back and say, listen, can you just give me the crib note version of all these PDFs, all these hundreds of hours that you put into my financials? And this is really what morphed from all those conversations. So this is right in front of you in your email. It is a quick bullet check of where the highs and lows, color coded, so this way you can focus on the red, not the blue, because the blue is good, red's bad, and dive deeper into the conversations, and then look into the information we provide to you at your fingertips to dive into what is, makes up those numbers.
And it went both ways. So we started providing this chart, and then no one started looking at our financials. So we're trying to find that perfect blend of everyone needs to be looking at the chart, figuring out the areas that they're above in, and then we can help advise how to best attack those areas. How do we make changes? So the way that this chart on the top section foots is exactly how our financials will read. So if you can picture a P&L in your head, the top of the P&L would be your net income. Your total revenue. So the revenue that we are journalizing is going to be based off the MR080. That's the accrual-based revenue. We have a question. All right, the accrual-based revenue. So the therapist esthetician wages are a percentage of that accrual-based revenue. So for example, this client is paying 30.78% of their total revenue to their therapist estheticians. This is below the national benchmark as well as the state benchmark. So getting into the benchmarks, and I think that is what the question is about, but I'm going to summarize it on a large scale.
We'll answer the question.
So then the national benchmark is, we have revenue buckets. We break the revenue based off of operational revenue. So if your operational revenue, meaning your total sales, is between 0 and $1 million, we're going to put you in a specific national benchmark. Then if it's between 1 million and 1.25, we're going to put you in another benchmark. If it's between 1.25 and 1.5, and that goes all the way up to 2 million in $250,000 increments. The state benchmark. Depending on the state that you're in, we may have a state benchmark based on your individual state. If we do not, then we are going to analyze what benchmarks you are currently falling under and figure out a state that may have comparable information or comparable costs to where you're operating, and then advise based on that information. So therapists, estheticians is an area right now where everyone is having a hard time getting therapists and estheticians, so people are starting to pay more. So for the different price points, there are different amounts or different caps that we need to put on the therapist and esthetician wages, inclusive of bonuses, and this must be an average. So for example, at a $60 price point for our membership fee, we cannot pay therapists more than $21. Now that's an average, so you can pay your highly skilled therapists and estheticians more than that. However, the average between all those wages needs to fall below 21%. That would bring you to a 35% benchmark. So this person has paid 30.78. They're below both national and state benchmarks, and that would mean that if they were at 35%, their average would be at $21 per session. The question that had come in is the state benchmark something you can change to a regional benchmark? Absolutely. We can make changes to this chart. It's something that we have created by hand. So there, it can be curtailed in many different ways. We just would need to get enough presence so that it's an accurate benchmark. So if you only have,
And maybe we can kind of go into how do we create the benchmark with the price points?
gotcha.
You know, what we do.
So as I was indicating on the revenue, we look at our client base of 200 locations. We split those into the different revenue categories, and then we do carve out 2 of the highs, 2 of the lows, and then we come up with our averages from there. It's based on prior year information, so these benchmarks are based off of 2017 information, and they're also based off of annual data. So you'll notice that EBITDA is, for this particular client, is above on EBITDA, which is most likely a November or a holiday time of the year when that EBITDA is going to be above that national benchmark. And the reason why EBITDA is challenging to do on a monthly basis is we all know the highs and lows of the business. During the summer months, there is no way you're going to hit that 21% EBITDA, but the average for the year that we're going to push you to be at is going to be that 21% for this specific revenue category. The state benchmark, we usually just take all of the clients that are located in those states, or regional, which would be possible. We would just take that data from the prior year, make sure that it's a large enough sample size, and that it's not going to skew the information.
And that's important as well, because nationally, although things look one way on a national level, once you start focusing on the individual areas, there is large swings in different numbers, different rent, different labor. California compared to the Midwest, the labor percentages are extremely different. Rent from the southern states compared to the northern states. So everything is a major factor. So, we do have both, and we can do both as far as state and or regional.
And the state benchmark, as you can see in this example, the fact that the therapists and estheticians are at 35%, this is a northeast benchmark chart, and you'll notice that their net ordinary income, which I'll go line by line and explain each line, net ordinary income being operational profit, is what we're going to drive you to be the most profitable in, because operationally we need to be profitable, is only at 2% for this person or this location. That is what was concerning before a lot of the price point changes, and still is concerning franchise-wide. Going line by line, so we address the therapists and estheticians. The concern here is that we're making sure that that average therapist wage, we just got off a call with a client the other day. Their percentage was 37% on one of their locations. They had a second location, and it was only at 34%. So the disparity was, on a 37% benchmark for therapists and estheticians, we would expect that they would be very seasoned therapists, very seasoned estheticians. We had to give them raises for the last 10 years. And that wasn't the case in this scenario. It was actually a newer location. And that also impacts the benchmark, because they had a lot of transfers in, so they weren't getting the whole entire piece of the membership due. And there were disparities in their payroll, so we're going through those. So when you're looking at these charts, that's what we're looking at in therapist physicians. How do we get that below the 35%? Because as soon as we get anything above 35%, it's coming straight out of the owner's pocket, and it's coming straight out of EBITDA. So it needs to be either corrected or blended out over time.
And that's important. The mention here was 37%. The state benchmark is 35%. It's important to know when we use percentages, what does that translate into dollars? So every 1% of $1 million is $10,000 to the bottom line. Everyone's usually a little bit more north of $1 million, depending upon where your business is located. But you're talking 2%, so 2 basis points over, 20,000 minimum to 30,000 plus. That's right out of your pocket. And the idea here is if we're doing our job appropriately and we're doing it efficiently, our services should be free because we should find enough pieces here that we can focus on and improve with you to pay for the services we're doing. So here we're going from a 37%, bringing them down to a 35. That's a $20,000 to $30,000 annual savings. That's just a home run right there.
Excellent. So oils, lotions, and murette. This is the Meyer DC orders. This is an all-in number for all the usage of Meyer DC. That should never exceed 2.5%, or nationally, it's not exceeding 2.5% of our operational income. And for this specific state, they're actually higher than that. They're at 3%. This location is running at 1.9. So what are we looking to cover or check on here? We want to make sure that there's inventory procedures. Where is the inventory kept? How many bottles are kept on the shelf? Are we allocating properly between retail and service supplies? Making sure that those are broken out, and those Meyer DC spreadsheets right now are what we're having our clients send us to make sure that those are broken out on a monthly basis. So when you get these set of financials, you have proper profit margins on your retail products, as well as are the therapists, estheticians using too much oils and lotions with the service? How is that tracked? Do we have bins for the therapists? Do we have bins for the estheticians that they come in before their shift, they pick up their dolly and they bring it back at the end of the day? And did they use too much?
Right. Is there a lot of training involved? There's a turnover for estheticians, therapists, correct, and so forth.
Linens. Linens is a benchmark that is consistently over for every client that I take onto our services. And the reason being is the way the linens company works is they have a set amount to ship to you every week, and they end up just truing up what's ever left on your shelf. So there'll be 100 sheets that are left in your shelf, and they drop off 400 and they bill you for 500. So every client needs to be keeping a pulse on their linens as well as their linen company to make sure that they're staying below that benchmark. And this person is below that benchmark, and linens can get as high as 2.6% in some regions. And there's little that they can do sometimes.
Right. I think he was at 2.8 originally. Now he's down to 1.15.
Right.
Which is incredible.
Rent. Rent is one of those expenses that when you speak to your accountant, you say, well, it's a fixed cost. I can't change it. The reverse opportunity is how many members do I need in order to facilitate my rent?
Right. And the rent, which is a great number, because a lot of our clients are like, we want to go into this geographical area. You start most of your benchmarks, your financial planning based on your rent number. Sounds awkward, but ultimately, if the size is too small, too big, how much, as Greg said, how much services you need to bring in to equate your rent below a certain number. That rent, if it's not met or impossible to meet, may not be the best location for you to go in, because you're not going to have enough room to facilitate enough members to start hitting these benchmarks.
And with newer locations, when clients are looking to expand and create satellite locations, making sure that smaller space, although the dollar amount's lower, making sure that is going to be plausible, the top line revenue number. And based on the amount of rooms, we can really get a good and accurate picture on will that location be able to survive there to the best of your ability when you're looking at the Buxton reports and the wealth in that area. So rent becomes a very important conversation that we like to have before you open, to make sure that the all-in rent number doesn't put you in a place where it's unattainable, because there are locations that are our clients that have unattainable rent numbers where their revenue will not be able to get below that 12% benchmark, and that's going to come straight out of EBITDA. And as you go down this chart, if you come into each area and you say, okay, it's not possible for me to change the therapist, it's not possible for me to change the rent, all those percents add up, and then it reduces your EBITDA, which is ultimately going to reduce your sale price, and the exit strategy would have to change at that point. Sales, reception, and management. This location is running at 12.5%. The franchise at the front desk has changed drastically over the last 3 to 5 years. The amount of time and effort that's required on the front desk currently is more than it ever has been. And the sales, reception, and management benchmark nationally always used to be 12%, and it never mattered. What your revenue was, we could always get everyone to 12%. You'll notice that our national benchmark has changed to 13, and those benchmarks do get down to 12%, but not until you get over 1.75 million in operational sales. And as you go further down, if you get down to 1 million, that sales, reception, and management benchmark is actually 17%. So there's a 4% difference, which makes sense because it's one of the fixed costs that we have where you have to staff the front desk and we have to look at the hours. So we've gone into our top 25 clients with their front desk structure, and we've looked at the amount of hours that their front desk are working. Then we compare that to the service hours of different locations, and we give them goals based on how many service hours and how many hours the front desk are working, how many they have to either shave off or become more efficient during, because closing rates are not what they used to be. The sales process is changing.
Competition is getting more and more, the right in your back door every day.
And locations are closing. So the sales, reception, and management cost is almost always above the benchmark. This location was not, like we suspected this was during one of the, this benchmark is from a holiday month, which is easier for you to hit some of those benchmarks because you have a lot more traffic coming in at that time, and that's our time of the year. And sales, reception, and management is something that on every call we are reviewing those front desk hours and making sure that are we above, are we below? If you're below, I'm asking questions. How are you doing this? Is your manager picking up front desk shifts? So those are the things that we're concerned with in this benchmarking. Personnel expenses.
And one of the things to note, I know we keep on mentioning it's a holiday month. Everything here is done on the accrual method. So even though the cash flow in a holiday month may be coming in, they're not really skewing your percentages. But we're basically saying these are really times of the year where you're most profitable versus, as we said earlier, the summertime where you're not as profitable.
Yeah.
But the cash flow itself piece, if it's not earned, is not in these numbers. So these are true indications of how the operations are running.
And there's a difference of about $15,000 in this given month, and that's actually in the revenue and income overview, which we'll get to in a second. The operational revenue for this clinic is $123,000, which I skipped about 4 or 5 lines down, and the total monetary sales are at $138,000. So you can see that difference in what is being sold versus what is redeemed, and all of our benchmarks are based off the $123,000. And if the percentages were of the 138, we'd have a lot lower numbers. And it would be difficult to determine how the efforts of your therapist estheticians are transitioning to operational profit. The personnel expenses line, jumping back up, is at 22.9%, which is above the national benchmark. So you'll notice that typically what we see from sales, reception, and management, this is actually included in our personnel expenses. Our personnel expenses are all the costs associated with payroll. It's our payroll taxes, it's our manager's bonus, it's our workers' comp, it's our EPLI insurance, it's our training, it's our background screening, which is a larger cost. It's our recruiting. Anything that is required from a payroll standpoint to help employees grow, to bring employees in the door, that's all included in that personnel expenses. Typically, what you'll see is 12%, or what we'd like to see is, on the national basis, you can see that it's 13% is the sales, reception, and management cost. And then of that 22% of personnel expenses, 13% of that is directly from the sales, reception, and management wages. So the payroll taxes, the workers' comp, that is going to make up that 9% difference. And you'll see on the actual, they have a 10% difference. So we would look into their individual situation, and we'd say, well, are they in a state that has higher payroll taxes than the national benchmark? Is their workers' comp rate through the roof? Is their EPLI insurance through the roof? So those are the questions that we're asking. Those are the questions that we're asking those clients, or just discussing as frequent as possible with them.
We just received another question. Actually, I can see that.
Yeah.
No, that's okay. How do you
do monthly benchmarking when employees are paid biweekly? So that's a
question.
Great question. On a monthly basis, we are going to look at your pay period. So you could be weekly, you could be biweekly, you could be bi-monthly. That period we are going to accrue. So for example, if 7 days of your payroll applies to 1 month and 7 days applies to the next month, we are going to take that payroll that transcends the month and make an adjustment so that 7 days of the total payroll is applied to the first month and the remaining 7 days is applied to the second month. So that way, when we book our revenue and we compare it to your payroll, the amount of days that were in that month, if it's a 30-day month or if it's a 31-day month, we're going to make sure that those payroll costs match that revenue, so you have a really accurate picture every month on how your sales reception management is operating based on the revenue. And we don't wait for any months that have, so any month, a common response that I'll receive from a client would be, oh, I had 3 payrolls hit this month. That's a difference that will never impact our benchmarking, so that on a monthly basis, you can look at month over month, apples to apples.
And also in addition to that, I know everyone's always looking for expediency. I want my numbers sooner, quicker, stronger. Ultimately, depending upon your payroll frequencies, depending upon your closing of your financial statements, depending upon your credit card closing statements and so forth, we can always bring everything quicker. The goal here is to basically get it right and have intelligent numbers. So we do want to spend the time, energy, and effort. And sometimes your payroll cycles will change the month frequency of when you're getting your financials. If you're paying every 2 weeks and there's too large of an accrual, or if this is towards the end of the year where you have a lot of extra staff coming on for gift cards, you want to capture the right numbers and not use a prior number that is a weaker number. So these are all the things that are communicated. The data is king in this environment.
Net ordinary general operating expenses, the next line on the benchmark chart. So you'll see that the national benchmark is 10% for general operating expenses. So what is included in general operating expenses? One of the expenses is actually royalties, which will be, generically, we'll say it's 6% of your total monetary sales. Depending on your location, how old it is, that would change. So of that 10%, 6% of it is already going to royalties, and it's usually over 6% because these percentages are of your operational revenue, not your total monetary sales. So these are not based on the flash reports, these are based on the MR80s. So the reason why it'd be a larger percentage is usually your operational revenue is lower. If your operational revenue is higher, then it would be less than that 6%. That would leave 4% left for office supplies, operating supplies, all the telephone expenses, software, Millennium, all the nickel and dime, 0.25% areas that we would look into. So for this location, they're running at 10.98, which is above the national benchmark, but below the state benchmark. So what could possibly be happening in the state? Are they having problems with their telephone vendors charging too much? A lot of this is controlled by corporate, so there's very few areas that you probably do have control under. Office supplies and operating supplies, which would be items such as Costco, Sam's Club, generic vendors where we're just buying paper towels, things of those natures. We want to make sure that those are not too much in certain locations or not enough in others, and we want to make sure that we're looking at them. But looking at 0.25% is not the best use of our time as well.
Right. And one of the things here too is we get a lot of questions in regards to the gray area expenses, which was owner/business operator expenses. So we'll actually, look into that number to pull things out of that number in the sense of, okay, this is truly not an operational expense, for this location, but it is a business expense entirely in itself. And we'll put those below the line outside of these numbers. We'll have conversation with owners, if there's automobile travels, if there's insurances, we call them the owner expenses that technically may be spread over other companies, but we just don't want to pollute into this number to falsify the numbers to get a better understanding of how the business is operating. And that part is, again, part of the detail that we set behind it. We go through with the operators identify those items that are, and to ensure that these numbers are accurate as possible.
Some of those gray area expenses.
How are we doing on time? We got a lot to do, so.
Yeah. All right. So the net ordinary income is the next. This is what we are always striving to bring to the highest level. This means after our therapist and esthetician are paid and perform the service, how much are we profiting on those services? We need that to be profitable at a minimum. It needs to at least be break even or more than that. This location for this given month is at 15.18%. You can see nationally, we're only profiting around 9.5% in this national benchmark and only 2% on the state side. So this is a great month for this location, and maybe they have negative months in any other given month. But this net ordinary income is what we are going to preach as your accountant, that we need to make it as high as possible, because the EBITDA, which then adds in the unused memberships and gift cards, will then be just that much higher, and that will be gravy on the top. Because if we're operationally profitable, then this business won't have a problem. Right. We just need to make sure that we get to operational profit, and that it's possible with our rent, with our payroll, all the expenses that we have control over, because there's a lot of expenses that corporate has control over. And as franchisees, I know everyone knows that. You have marketing, we have Project 4, the list goes on, and the list we only keep adding to the list. It doesn't keep getting smaller. So operational profit is something that we're going to make sure is attainable and help make tough decisions with our franchisees to make sure that they're getting there.
So as we can see, this is a very powerful chart. It's very small, but yet, within it, you can see a lot of detail. Behind this is all the data you would get on a monthly basis that shows how these numbers are computed, these percentages are computed, and it allows us to go for a deeper dive. To kind of generalize some of this information, because it is, we're running a little bit out of time, the revenue and income overview, you can see where operationally making monies, monetary making monies, cash flow, operational profits, net income. These are all very valuable tools. And from here, we can dive deeper. And as Greg was saying before, the operation of the business usually is not very highly profitable. And to get it to a point where it's break even or profitable usually means at the end of the day, you're going to have cash flow in your pocket. And these are the individual tables that'll help us, derive where we can help you to get there. The biggest thing for me is the potential increase, decrease in taxes due. So it's almost a mini projection. That area for us is just to keep people as a pulse. How are we doing from last year to this year? And basically, what does that mean for you? There's no surprises by April 15th if you're going to owe money or not. We do a larger, deeper dive for projections in the November, December time period, where we'll have conversations with our clients, show them the business income. If we do the personal return, we'll bring it to the personal level. But ultimately, every time, James, I don't want surprises. Gregory, I don't understand. Why do I owe so much in April? This here will give you an indication of what that will be for you in April. Prior year is higher than last year. What does that mean in English? When you do estimates for your personal return, basically you're using 110% of last year method and or 90% of the current year method. What we're telling you is if your income is higher, this will be the potential tax that's due. If your income is lower, your projections or whatever we had guidance for giving you for the prior year that you're paying for the current year is still accurate. And this is just an indicator for a conversation. It's just an earmark we always get all the time. Oh, by the way, my daughter turned 16. I used all that money to pay for the Sweet 16. My kid's getting engaged. Oh, my kid's in college. This will keep a pulse on your pocket to make sure that at the end of the day, we do need some bucks for Uncle Sam when April 15th comes around. Moving along, now's a great time. If there's any additional questions coming in are great so far. I don't know if you guys have anything in particular. If not, we have 10 more minutes. We are going to
just summarize the background of our services and what you can expect as a monthly client of ours. And the next slide you can go.
So what happens from here? If people do want to come on, if they want to add additional services, it's a very easy, systematic system. Brian, maybe you can kind of go through some of the things we do for onboarding.
So we try to streamline our onboarding process as efficiently as possible. So instead of filling out paper, we set up an online startup form on our website. The link is there, and we'll send out the PowerPoint after the webinar. So you can just click the link. It's forms.grossifranchiseservices.com/MA. You just type in your startup information. The only thing I want to point out on the startup form is that you cannot save it. So I recommend printing it when you're done, just in case your computer crashes, so you don't have to redo everything. You could just send us, scan in the printed version, and then we could take that from there. We'll collect your login information. We'll get view and access to your banks, your credit cards, your payroll, all these stuff that we need to get going. And then after you submit that, one of our implementation specialists will reach out to you with some additional documents needed. So we'll get a signed engagement letter, a signed ACH form. We'll get acknowledgement that we could upload your P&Ls to Profit Keeper, copies of your recent tax returns. So then going forward.
So basically, we try to make it as seamless as possible for the transition. Each transition varies, but usually it takes about 30 days to get all the information in, get everything accessible for download, and then from there, by the I would say the second month, you're ready for running full head of steam, and you're having conversations on how to do deeper dives. So the process is pretty streamlined. Obviously, depending upon when you do come in and don't come in, may change the operation of the timing, especially during tax season. But ultimately, in the end, it's not really a expensive process anymore with technology. Summary of 2018 tax reform. This is usually a 3-hour CPE presentation we'll give for internally as well as externally. Obviously, we can't do this in, 5 minutes? But we can kind of go through one of the major 10 minutes, or even better. So there are some, let me just go through some highlights. We're more than happy to answer questions. Even if you want to send us questions afterwards, we're more than happy to go through those. We get a lot of questions throughout the year, which, Donald Trump doing. Obviously, no one has a clue what that man does, but he is making some significant changes. The biggest thing, of course, is the accelerated depreciation and the 20% pass-through for entities. Some of the items affecting you personally involves meals. That is a bigger one that seems to stop everyone in their tracks. When we do give these presentations live, this is what stirs the crowd the most. Ultimately, we had the ability to take 100% deduction when we paid for our employees for the convenience of the employer. That's been carved down to 50%. On the individual level, we had the ability to take state taxes and for payroll purposes, any withholdings for the states, as well as any state taxes you pay for real estate property. That's been carved down to $10,000. For individuals, for yourself, your kids, this was one of the benefits for having kids. Normally, I would ask show of hands how many kids people have kids that are born in December. Great tax planning strategies. I love it. Now there's no sense of having a child anymore because they got rid of all the dependencies. So it's a bummer. Ultimately, there is a max $24,000 cap as far as what the IRS is giving you on a joint basis. I have that for an individual. Most of the people, that we deal with will still have itemized deductions, but that amount of money they're deducting will be significantly lowered. Mortgages have changed. Anyone going into a mortgage currently, instead of $1 million, is now down to $750,000. Home equity loans are not deductible, but you can do some interest tracing to see if you're using those funds for businesses. And I know we're going very quickly, but I do apologize for that, but I want to get as much in as possible. Tax brackets have changed. The biggest point here is that it went from 39.6% to 37%. There was some blogs out there now that the elections are over, that they want to bring it back to 39.6% from 37%, and then change the corporate tax structure from 21 to 25. These are all proposed regs. Nothing's final. They call it Tax 2.0, which is still currently being processed. It may change everything we're telling you, but we believe the core root of everything here will stay in some form or fashion. I thought we moved the slide up to 20, that whole graph. Oh, yeah. So,
you keep going.
Yeah, so
Just click through.
we're gonna, there we go. This to me is a great graph. We did not create it, we stole it. We did give credit to whoever did create it, but ultimately it's accurate. It's a good table to use to see where you fall out in this 20% deduction. We can try to go through it. I know I don't have a lot of time. Looking at your taxable income, If you're above or below thresholds, look in the top right-hand corner. It tells you what that means. What does that mean to you in English? And this is why you need someone like us to kind of explain these things. It's great to read. It's great to put everything in a format and send it to you, but ultimately there's a lot of explaining that needs to be done. If you are married, filing joint, you have an income threshold of $314,000 or under, then all these second tier limitations, the whole chart is meaningless. You just take your 20% from your business flow through and you're done. If you exceed that for gross income, then you got to go through this whole rigmarole to see whether or not additional deductions or limitations may apply to your 20%. And there's a two-pronged formula. So you have QBI, which is basically qualified business income, and take 20%. You look at wages where there's 50% wage deduction, whichever is greater, in this case, whatever is less. So if your 20% deduction is less than your W-2s, you take the full 20%. If 50% of your W-2s is less than your 20%, you take the W-2 limitation. There's also another prong test where you look at 25% of your wages and 2.5% of qualified property. This is all extensive stuff. This, like I said, is hundreds of hours of reading through code. As much as I love it, I'm sure you guys enjoy it as well. We can kind of go this in more personal nature if you guys want to have conversations for it later. How do you go backwards?
Right click.
That's not right.
Back.
Yeah.
Previous.
Thank you.
Up.
So, kind of go back a little bit, it all starts with your pass-through entities, and this was what Greg was saying earlier. These are conversations we'll have before you open up new facilities, even when you have current facilities. How important is it to pick the right structure? LLCs, that's just a business designation. It's not a tax designation. You have the right as an LLC to be a partnership, an S Corp, a C Corp. Each one has significant details, highs and lows, and you can't just give a general answer. So these are conversations you must have with us. So this way we can depict what you should be using. And each business actually affects the 20% rule as well. So wages, if you're paying yourself too high of a salary to max out on the pension plan, those wages hurt you in the sense that you can't get a deduction or an add back for the profit. So you've got $100,000 of profit and you pay yourself $100,000 in wage. That zeroes your profit. You get nothing as far as a 20% reduction from your business profit because it's zero. Guaranteed payments are the same thing. So do we want to maximize on wages to maximize some of the pension plans? Do we want to not maximize wages to maximize the 20% reduction? These are all the pieces that we have conversations today with, especially towards the year end, to maximize the bottom dollar. As we said, we want to earn our fee. The fee that we charge should be dwarfed by the monies we save you. Owners of pass-through entities do not pay tax. Income passed through to owners personally, K1s. So these are all the great conversations we're going to have. I know I only have a few more minutes. Some businesses don't qualify for the 20%. Good thing is you do. So this is something you should be having conversations with your tax preparers on a personal level as well as a business level. On a personal level, there are aggregation rules, so you need to make sure that your individual preparing your return is up to date on these rules. If not, they will make you lose money. Some terms and analogies to go through what these means. In these slides, we can always send out to you. And this is what we're saying before about guaranteed payments and salaries. And you have individuals that are multiple owners that are not related. That becomes very important because in order to true up the disparity of income to each other, you may have to create a wage as an S Corp or guaranteed payments if someone's putting more personal effort into the business versus others. And yes, again, I'm in New York. I speak very fast. I do apologize. So you can slow me down. I can stop here if you guys have particular questions. If not, I can kind of go through some more. But I don't want to go too quickly because then it'd be really hard to grasp on the highlights. But as we said earlier, there's a lot of great changes. There's a lot of great things that we can have conversations on. As you can tell, we love to talk, which is odd for accountants, I'm sure. A copy up here is a 1040. You're going to cut me off. Got it. Is basically with the new form. It's really on one page. All the magic happens outside the form, and it just gets stuck on here. So this is really a summary sheet. And then, of course, you have all the subsheets and so forth. What are the eligible assets? The biggest thing is leasehold improvements. That is the unsung hero here. IRS made a mistake how they implemented the code. The IRS basically, when they said that, put everything in motion. Leaseholds went back to 39 years. We believe that is not the intent of the IRS. We've had calls with the IRS, and verbally they have said that's not the intent. Unfortunately, nothing's in writing. Way back in the early part of the year, we thought they would change it. By now, they haven't. Our firm is still under the assumption that they will keep the 15 years for leaseholds. which gives you the ability to take bonus as well as Section 179. Methods allowing write-offs. The bonus feature changed. We used to have 100% bonus, but the bonus depreciation was only up for new assets. That's changed. Now you can use new and U. 179 and bonus seem very similar, but there are some strategic differences. Self-employment plays a key factor. Normally we go into that and spend a lot of good time on how we can minimize your self-employment tax, depending upon the type of depreciation to take. That's all. And the bottom line here is, the folks that are educated in your franchise live, love, breathe your franchise. They know this very well. Obviously, not as well as the operators, but we do learn from our good operators to pass on that good knowledge to yourselves. I know we're running really close on the end of time. If there's any questions, by all means, send them in. If there's anything here that we went too quickly on that you want us to kind of go backwards with, send us an email. We'd be more than happy to jump on a call one-on-one. And basically, these are the numbers here if you want to get in contact with us. And that's pretty much it. So thank you very much for attending. We love the opportunity to present our information to you. And as we said, we're here and available, so please let us know if we can help. Thank you.